Hedgeless Horseman here. It's June 21st, 2022. This video will just be a simple reminder that value investing is pretty much 5% action, 95% waiting. This current downtrend and sentiment decline has amounted to around 683 days. That's not many people that can suffer through that kind of thing. It was actually even longer, the decline from the 2016 top to the 2019 bottom. So it's still not even the longest downtrend since 2016. That's just the last 6 years. And what you see here in the juniors, typically that again, which I've stated before, that the big rallies, etc., they are in a much shorter time frame than the declines. So if we consider this to be the actual final bottom decline of this one, we're talking 1,319 days, and then everything was forgiven, so to speak, in just 129 days. So from this point here, this time period, to this time period here, this strategic metal stock, which is a sentiment proxy I use, it retraced the whole movement pretty much back to here. And like you see now, it grinded here for a time, and then we got going, and I thought, okay, maybe, who knows, maybe the juniors are about to get more expensive again, that you have a downtrend, it's broken, and the bottom is in. Obviously, it fell back when the market crash started happening for real. But if you zoom out, this hasn't been the exactly same company, obviously, since 2008, 2009. The only thing we know is that it's Strategic Metals is, I think, trading for less than cash and marketable securities, somewhere along those lines. Certainly, objectively dirt cheap. And if we assume it hasn't changed too much, you can see the amount of times and the period of time this stock, for example, has traded at a lower price than the current one. Brief time here, say it was a month here, less than a month here, just touched this a few times back here during the 2015-16 bottom of the massive bear market. It grinded here it touched here already, so kind of perhaps similar to this, and then it went up, but then it grinded down again and stayed under this level, or bounced under this level, from late July to January. So that's still, several months of grinding action at this level here before all of a sudden, boom, retraced all share price action since 2012. So 4 years almost worth of decline got recouped in 7 months. This is the main thing, I think. This is the hardest part, the waiting. Because this was cheap. I'm pretty sure this was very cheap. I'm pretty sure this was very cheap. But you still was in for a year-long decline in addition. And of course, in hindsight, it's pretty apparent that buying here was not a mistake. Certainly not a mistake. Buying here wasn't even a mistake, depending on time frame, of course. But every buy since this level pretty much got forgiven at this point in time. So you could have bought for, like, I don't know, 2-3 years, and you would have seen no returns. And all of a sudden, if you just play with the thought that the only stock you actually own was Strategic Metals, So your portfolio would be underperforming and then going nowhere and then underperforming, let's say. And you just kept buying and buying and maybe you were down, who knows, 50%, let's say. And then all of a sudden your entire portfolio is a multi-bagger, even though you started buying here. Obviously, as per usual, the lower you bought, the better the buys. So if you bought here, that would have been 24 cents up to 84 cents. So yeah, that's a serious multi-bagger. But point remains that we have no control of when sentiment changes. So I don't even try to. I mean, I look at charts. I look at stuff like, okay, the comics inventory is going down. It appears that the silver prices, paper silver price is probably too low because inventories are going down, and you see central banks ramping up the gold purchases, etc. You see the world turning worse and worse with inflation. So you can kind of see that yes, the system appears to be the financial system, monetary system, fiat money appears to be the decline seems to be accelerating. So at face value, you would think that, I mean, there's literally the time of, or the reasons for buying gold just keeps increasing, and silver, of course. And now rates have begun to go higher, as mortgage rates are going higher. I mean, I've already seen some apartments out for executive forced sale or whatever it's called. Basically, people defaulting on their mortgages. So it's like we're starting to see cracks, and I would say the real moves maybe have yet not even started. But the point remains that buying low and buying cheap is never a mistake, especially at face value. But yes, things can stay cheaper and become even cheaper for a long period of time. But it's like I know I'm buying low. I know I'm buying low. I knew I bought low when I started buying. I actually had pretty good timing back here, but when I started buying juniors, this was around this time period. And I remember my portfolio was down 50% from this level. In hindsight, you would say, wow, you bought incredibly low. Yeah, but it didn't feel like that when it went down 50%. It's same thing. It doesn't feel like you're buying low here when it goes down here, or here when it goes down here, or whatever. Or here even when it goes down here. I mean, that got cut in half again. But you can see at no point, especially for strategic metals, which now is basically pricing in nothing of its projects, at no point since 2008 was buying here ever not profitable if you held on for, I guess this would be at least 2 years. So that's the whole thing. It's like game theory. What's the worst that can happen if you buy all these juniors incredibly low, closing in on almost nothing in terms of enterprise value? I mean, we know they're undervalued. We know they should be higher. We know we don't find enough gold to cover what we take up from the ground, and we know that the juniors do not reflect the fact that future supply is getting increasingly important, because the juniors are the future supply and they're going down in price. So Mr. Market is saying that the value of the future supply is going down. That's simply not correct. It's not even correct, in terms of the current price environment. So Mr. Market is totally wrong. But Mr. Market can be very wrong for a long period of time. The longer a downtrend persists, the worse sentiment gets for Mr. Market. And we've seen stuff with, Line 1 metals after the barn burning hole. I remember it opened up 14%, I think. I don't know exactly where this is the day of the announced discovery after the trading halt. I don't exactly remember. Let's say it opened up around here or whatever. Or actually, where's the open? Maybe it was that here? Just here? I don't know. Anyway, in my opinion, the value, implied value of the actual results, what it meant for Lion 1, was way more than the initial market reaction. So I started buying shares of Line 1. And then it traded up to $1.66. And then down to 1.30. I mean, nothing changed in the meantime really, except market gyrations, etc. But you see these wild oscillations on the same news release. No new information since the new news release, and you still see this kind of movement. I thought it was a joke that it only revalued that much, so I upped my position considerably. And another great example of that is, I think, Goliath. They just announced that they hit 95 cumulative 95.5 meters of broad intervals of mineralization in first hole of this field season. And where was this hole located? This is from Pad J. My case for Goliath, why I like the risk reward, is because I thought it was the Mr. Market's price was, in my opinion, too low for the reflecting the risk-adjusted value, implied value, let's say, of the sure bet zone. Because we know they've hit, we don't see the actual holes right now, but we know that this hole hit, that was a 1 kilometer step out pretty much. They hit in every hole drilled last season. So that kind of tells you again that this appears to be a very robust, predictable system. Basically a sheet-like system, and it appears the mineralization is strong throughout. I mean, there will be lower grade areas, of course, because the fluids don't dump out the exact same metal all over the place. Some hole hit like, I don't know, 35 meters of 8 or 10 gram per ton AU equivalent, and some were lower. But the important thing is that the system appears to be very robust, etc., and sheet-like. And they thought that, hey, maybe there are more, let's say, detached plates of the same system, something like that. And now they hit in this Pad J here. That's 1.5 kilometer from the outcropping shorebed zone. That's 2 kilometers from where they hit that real deal. Apparently 2.1 kilometers from, I guess there's some prospect down here maybe. And it's 2.5 kilometers to another potential, they stated in the news release, they will drill this new gold zone with a series of holes. I mean, look at the blue sky, the theoretical blue sky, is nothing you should base your, that's not the value of the project, of course. That's just a theoretical, like if we get everything we want, that's the theoretical value. The more important thing is what's priced in of that blue sky. What's the chance of success that's priced in, for example? If this alone, and these are just my thoughts, I think this could be a multi-million ounce system, potentially very high grade. We know that Great Bear got sold for 1.9 billion. They didn't have a resource out, but let's say it's, 8 million ounces at least and open. So that's like, almost $200 per ounce. I'm not saying this is another Great Bear, but it's like, okay, high grade Canada underground. So a robust high grade underground system, and the metallurgy looks very good so far, which is, a big bonus. I think it was around 65% something that could be potentially recovered via gravity from the test samples they did from the shorebed core. So it's like, what happened to the blue sky here? We don't know this is going to be mineralized. We don't know what the footprint is here. It appears it's going to be a potentially massive system because, okay, we know the system is here. And now they hit something similar way over here. So if you look at a shorebed zone and then you look at all the distances here, you could put another shorebed zone in here, for example. But even if it's just this area, for example, that could still be like, 2 million ounces. And if they hit up here, I mean, it's just, let's put it like this. Before this drill season is over, because they're gonna be drilling all over the place here, you can see the pads here. So they will massively de-risk this area. And they will drill here, and they've drilled here, and they will drill here. Before this season is over, when they have drilled all the holes from every pad here, we might have an inferred system that is very, very large. And they just hit here. I think Goliath ended up 5%. I think the market cap increased by 4 million Canadian or something like that. Even less, perhaps. I think the market caps are actually around, what, 65 million? What's that pricing in? What part of this is it pricing in? What part of this and coupled with this is priced in? What part of everything here, including, you know, the prospect of having new gold, prospect of this system SureBet continuing, etc., is priced in? I would say very, very little. This to me is a unique system. It's the most predictable system I've seen. I've not seen a other company have a 100% hit rate so far out of 24 holes, except Elora Resources. This is just incredible, and that's why the best part of these sentiment lows, like I've done articles about, is that you can buy success after the fact without paying up. If this was a hot market environment, if we were in 2016 now for Goliath, I think that it would easily be trading over $200 million. This news release alone, since sentiment is hot and people think about blue sky, people actually dare to risk something based on potential, could have it up 60 million in market cap. Basically what it's the entire market cap of Goliath is right now. Just based on the different sentiment environment. So this, I mean, to me, this is a absolute joke. 5% on a hit like this. Even though we don't know the assets, we know it hit up to 95%. And it appears there's some chalcopyrite as well. There's some pyrite and pyrrhotite. I think it's, where's that described? Yeah, pyrrhotite, pyrite. And that's typically associated with gold in the drill holes at the SureBet system. So there should be some gold here. And there's obviously some copper as well. So maybe the system is, you know, transforming a bit, but it appears that this is indeed a massive system. They hit here 1 kilometer step out. They hit here 1.5 kilometer step out. This is going to be drilled. This could be, again, we don't know, but at the end of the day, this might be a absolutely massive system. And 65 million, which is the market cap, doesn't even come close to reflecting if that would be the case. Even if you discount that by a 50% chance, and then you discount that by 50% again, like 75% discount, I would say the risk reward is good. Even great in Goliath. And there still are no guarantees. It's just that how much do you make if blue sky materializes? How much do you make if 50% of blue sky materializes? What do you make if 75% of blue sky materializes from the current price? So this is why this sector right now is, I mean, in terms of future returns, this is figuratively and literally, a gold mine. Because you don't even pay up for the great successes. What's the odds of line 1 drilling the hole that they did? I mean, how often do you see that in the junior space? You never see that, pretty much. And even though it happened, like a miraculous hole, and you only pay up like 14 million. I mean, that's just ridiculous. Like, okay, you drill one of the best holes last, couple of years for any juniors, and your reward is 14% from a low level. That's entirely bullshit, in my opinion. But that's what happens. Nobody cares right now. No, absolutely nobody cares. There's no money coming in. I mean, I saw a microcap junior yesterday. It was up 20% from, I think, 6,000 shares traded, and the shares trade for 6 cents a share. Can you imagine if even $100,000 buy comes into any of these micro cappers in this case sometime? That $100,000 market buy could have some market cap companies up 60%, I think, if you just put in a market order. That's like, you can't have that kind of moves unless you start off from very low levels when sentiment is poor and there's no buyers. So obviously it's not buying in this period here or here or here or here or here or here. That's not good it doesn't feel good in the moment, because here you had months, even a year or two of downtrending action. If you bought here, you had, almost a year. A sentiment low and a bottom is supposed to feel bottomless. Like right now, it's again, even if your blue sky, even if you have your favorite juniors hit like this, even though we don't have assets, but put out incredible news items like this, and you barely get rewarded for it. That's the most frustrating thing there is, because at face value, you're taking on risk with no reward. If this missed, if they hit nothing, I bet the stock would have sold off. I mean, I'm not sure they would announce the visuals in that case, so it's like, to be fair. But if this came up totally dry, let's say we had an assay results and it was totally dry, no visuals, etc. Of course the stock would go down, even though it's cheap based on this alone. So that's why this kind of environment we're in now is incredibly frustrating, and why vast majority will not be around when it turns. Because if it feels crap right now, imagine if this continues on for 6 months more, whatever. Imagine we're here right now, and you have this to look forward to, quote. Almost nobody's going to be buying here. Almost nobody's going to be still in the sector here. There's going to be, let's say, a few very incredibly strong hands that are going to be left to be a part of the next leg up. So the waiting is the hardest part, especially when you already waited for a long time. And what people are afraid of, and like instinctively what I'm also afraid of, is we're afraid of the share price action tomorrow. We're afraid of what people do tomorrow or next week. Everybody is afraid of a broad market sell-off again. That's gonna get people to sell your shares. Almost nobody I see is worried about their actual, favorite juniors being worthless or worth less than the current price. Everybody is afraid of what the greater fool is going to do tomorrow, price action. And that's price volatility. If you have some of these stocks, value is here. Should you really be worried? Even though it's like, yeah, okay, you're open to the idea that this stock, even though it's probably worth this much, it's going to go down this first. To me, again, from a game theory perspective, what's the worst thing that can happen if you have a very diversified portfolio right now with dirt cheap juniors? It's that dirt cheap could stay dirt cheap for longer or get even cheaper for a while. That's the important thing. For a period of time, this whole sector cannot trade for almost liquidation value forever. It has never done that. It has never done that. It's never gonna do that. It's never gonna stay unless civilization stops or whatever. And right now, for example, in the case of gold or silver, it appears that the merits and reasons to own it are actually going up, and people are buying more and more, and we're finding less and less. and we're recovering more every year pretty much. So from a fundamental perspective, this is as no-brainer as it gets. The macro winds are with us. The fundamental winds are with us in terms of specific company valuation. Everything makes this, no-brainer buying environment. But nobody else agrees with us yet. Nobody else. That's the hard part. When everybody disagrees with you. Because if everyone agreed with you, you wouldn't be able to buy these juniors at these prices. So at the very bottom, you're going to be almost entirely alone. A lone bull. You're going to be the only bull left at the eventual bottom. Nobody's going to be interested in this sector. But it's from those lows that the future is looking the brightest, because the future expected returns are the brightest. Let's say, let's just play with the thought that Goliath hits on all of these. Let's say they hit on all of these drill holes. We would perhaps have an inferred resource like, who knows, like let's say 4 or 5 million ounces from Shorebet, and then we have an implied, let's say they hit here as well, maybe 3, 4, 5 million ounces more inferred, then they hit up here, and the blue sky here is like 3 million ounces before this field season is over, and the current market cap is around 65 million. The implied value of this, if they hit everything, that would be hundreds of millions or maybe over $1 billion. Is it a problem if you bought at $65 million? No, that would obviously imply that you're gonna have a serious multi-bagger, maybe even a 10-bagger, or even more than a 10-bagger. So that, again, we're buying the future at prices set today when sentiment is poor. That's the arbitrage. The market, when line 1 just went up, whatever, it didn't price in all future expected returns from line 1, what would come from a drill hole like that, or today or yesterday Goliath going up 5% because they hit a 95-meter long interval here, or combined interval. It wasn't pricing in what that meant, for what that means potentially for the Goliath story. No, it's nobody feels like buying. There's almost nothing fundamental about it. If this was fundamentally driven, line 1 would have gone, it wouldn't have retraced back here, it would probably gone up more, I think. Goliath would be up a lot more yesterday, etc. So it's short-term sentiment that sets price. And in my opinion, it's our job to buy the long-term value, and buy long-term value for prices set by the short term. And an interesting thing is, like, I saw this chart here. Here you have, I think it's S&P. This kind of looks like, 2008, obviously. Similar, let's say Head and Shoulders, yada yada, wedge formation, and it appears that it's broken that, etc. So that's what people are mostly afraid of. I mean, a total meltdown in the markets. That might happen, but if we look here, this is the price of gold. What I keep saying is that, don't worry about the present or the short term. Worry about what comes after the crash, let's say. I mean, let's say we're around here right now. If you could make a direct comparison. This is the price of gold. Yes, you had a flush even, when it went down further, but this is where gold bottom. This is just, when the cascading, selling cascade get going. Yes, we had another down leg in gold. It took it back to this level, basically undercut this a bit, so maybe that's down. Who knows? Maybe that's down here, whatever, in gold right now. But what happened afterwards? Gold went on a multi-year bull market with a blow-off top in 2011, and this is this period. I mean, what came after? Again, what came after? Let's say we're here. whatever, and you have a cascading. So let's say every junior goes down 50%. I have no idea. What happened to strategic metals when that bottom and gold got turned around? It went up over 2,000%. Does it matter if you're down 60%, if or 70%, if it 10 bags within the next years? Of course not. So that's also one important thing. It's like, yes, you might be down 50, 60% right now, and you might be down more. It's like, I mean, if you're down 50%, you only need a double to get back to neutral. And from these bottoms, juniors always go up more than 100%. So it's not really a problem. It's just that it feels like that right now because, okay, we haven't seen 100% pop in what feels like forever. But when these markets, these juniors turn, they go up more than 100%. Even the quote boring ones like strategic metals. So it's like, if I don't know what my total portfolio is down right now. I mean, I'm buying more every month, so it's not down 50%, the total portfolio. But let's say the stock holdings are on average down 50%. That's not a problem in my opinion, because I think that many of my juniors are going to go up way more than 100% when this turns. So it's, again, based on time perspective or cycle perspective, it's a problem. I mean, if you bought here and sold here, yeah, you have a problem. You just made a permanent, 50% loss, and you missed out on this. So it's like, I'm along for every downtrend. I'm along for the top tick to the bottom tick, but I'm also along the ride from the bottom tick to the next top tick, etc., etc. And if you have, growth stories, they typically do something like this instead. So they, go up, I don't know, 200%, go down 50%, up 200%, down 50%, up 200%, etc., etc. So it's like, in my opinion, if you're down 50% right now, that's not a problem. Even I think even if some juniors go down 50% more, I don't think that's even going to be a problem. As long as you're diversified, because not every company is going to be around for the next upturn. But if there's even a sliver of a chance that this is going to happen, that gold is going to go on an absolute tear in, let's say, start in 6 to months to a year, whatever. I mean, it doesn't really matter. It's all about perspective and time period. The only thing we know right now is that juniors are incredibly dirt cheap, and we know that during sentiment highs they become expensive. So the delta between incredibly cheap to expensive is huge. And that's what I want to be a part of. That's the only focus. Buy when it's dirt cheap, wait for it to become, let's say, expensive. Even if that takes 2 years, that's going to be well worth it. Even if it goes down 50% first and it takes 3 years, that would still probably be worth it. More than worth it, I think. So it's like, it's quite clear that you're buying low right now. That's the only thing that's really clear. We're buying low. We're buying low, but that does not mean that low can't go lower first. But from lows, the future gets exponentially more favorable. The lower this went, the higher the future returns were. The lower this went, the higher the future returns were. From this, it would be a 500% return, and then it just kept on climbing. If you bottom tick this to 2,600%, that's the only thing we know. So if I expect that the future returns from this level, for example, now is gonna be hundreds of percent in a cheap juniors overall. If it goes lower, that just means that the future returns go up, and you take short-term pain. But it doesn't take anything away from the future expected returns. It actually increases it. So it's the waiting that's hard right now, because I have absolutely no friggin' idea when the juniors are gonna turn. Absolutely no idea. I just know that they're mind-numbingly cheap, many of them. So it's like, I don't think I have a problem. I have 30 to 40 holdings or something. I think every single one of them has a future expected return of 200-300% at least. And in cases with, like, Goliath or Eloro or SK, or even, I mean, depending on what happens with Novo, for example, if they make something work with that cash hoard they have now, and equity holdings, etc. Any of those could go up if things go well. It's gonna go up way more than 200-300%. And I mean, some might do a 10 bagger in 3 years. Some might go nowhere. Some might go up 200%. That's why I like diversification right now, because I want to make sure that I'm a part for the next up leg. If I'm diversified at the bottoms, that's gonna pretty much cement that I'll be a part of an up leg. If I own two stocks down here, those might go bankrupt and I would miss out on this. If I own 30 stocks, 30 or 40 stocks, and across, with some other metals as well dabbled in, I mean, I'm going to be a part of the uptrend. Same if you're diversified up here, you're going to catch the full force of the downtrend because the average unit is going to go down. And from these levels, in terms of cheapness, the average unit is going to have a multi-bagger higher, in my opinion. Again, I'm just reiterating the, in my opinion, most important thing. That's the hardest thing to do. Knowing what to do right now from a price to value and buying opportunity, etc. perspective. I think it's when you account for the fact that gold is at 1840 or whatever, it has probably not been a more obvious buying environment. But the hard part is actually not, in my opinion, it's not buying low, even though that's hard as well. But it's being able to buy low, hold, and buy more the lower it goes. Basically, it's the waiting. Because if I know it's cheap now. If I bought right now, and it went up 200% tomorrow, that wasn't hard, really. But if you bought here and it went down 30-40% more, that's hard. That is hard. To trust the fact that sheep just got cheaper and it would be even dumber to sell and you should be buying more. That's the actual hard part. Looking wrong for an extended period of time, that's the hard part. And again, looking wrong, not being wrong, it's looking wrong. Because greater fools keep selling your shares even cheaper and cheaper and cheaper, and it's face value, it appears that, your strategy isn't working. Well, all of a sudden the strategy works and you make a boatload. So that's what I expect. It's like I there's no way I'm selling out of units around here. No way. And I don't know if we go down more first. But I am way past the point of selling. I mean, this would just be stupid sheep getting even more stupid sheep. This is how I look at it. It has, since I started, it has worked very well. And from a theoretical perspective, it makes total sense because you always know there are two things you can know: price you pay, and that sentiment always changes. So if you buy at a ridiculous price and you know that sentiment will always change, that means if you just keep the simple theory of keep on, let's say, holding at least, and buying the cheaper something gets, and you know that the sentiment will always turn. I mean, it would become pretty much impossible to lose money in the long term, because by default you're correct, but it's sticking with it and actually employing the strategy at all times that's the hard part. Thanks for listening. Consider me biased with every company I talk about. Some are banner sponsors, etc. Do your own due diligence, and of course don't risk money you can't afford to lose or need in the short term, because we have no idea what could happen in the short term. So you need to have staying power. the I mean, the nightmare would be like, yeah, okay, you buy in here, but you need the money here, and you're forced to sell, so you miss all of this. Now, so be smart about it. I mean, there's only risk reward. There's no guarantees, especially in times of timing. Terms of timing. Thanks for listening. Bye.